Everybody have fun.
Amy Jo, I just love your background.
I love that. It's just my house.
I love it too. I want to sit and read all your books.
Look at all the knickknacks and different shelves and yeah. So that's good
Great.
stuff.
Hello, everyone, and welcome to TMC Connect. We're going to let everybody filter in, and then we're going to get started at the top of the hour. Thank you so much for spending some time with us today.
Amy Jo, while we're waiting for people to come on in, you got to give us one of your favorite things that you have back there.
Oh gosh. Well, it's got to be my picture of my nephew right here.
Oh, yeah. You pointed to that before. You got it right away.
Yeah, it's right there. Yep. Yeah, he's my favorite. And I have a new one now. Sebi and Remy, my two nephews. So those are my favorite guys.
Oh, great names.
Yeah.
Love that.
And we've got Tony at home too, who claimed that his background was boring, but it's not.
He's got the nice mood lighting in the back.
Tony, it's very dramatic. I like it.
Yeah, well, that's what I was going for.
Definitely library look. All right, well, we are at the top of the hour. We've got 2 o'clock Central Time, 3 o'clock Eastern. Thank you guys so much for being here. I'm Tony Bramley, and I'm the Director of Business Development here at the Mortgage Collaborative. Today we are talking about mortgage. You know what? We've got mortgage experts debate 2023's market. Are there signs of recovery? And alongside TMC today, we've got Maxwell, one of our awesome preferred partners. Maxwell has mortgage solutions that offer comprehensive technology that address the full gamut of the mortgage process from point of sale through secondary. After this call, Maxwell will be sending out their Q1 2023 mortgage lending report via email. So be on the lookout for that. A couple of things before we get started. Thank you so much for being here. You guys have entered on mute, but we do want this to be engaging. So please drop your questions in the chat or the Q&A, and we will be reading those out as we go through this conversation that we're going to be having about the mortgage market. So before we get started, I would like for our panelists to introduce themselves. So Amy, I'd like you to get started.
Yeah. Hi, everybody. Amy Jo Plummer. I'm the Vice President of our Customer Success Group here at Maxwell.
Excellent.
All
And
right.
Brian?
Oh, all right. Thanks, Tony. I'm Brian Traeger, Managing Director of Corporate Development at Maxwell, deal with strategic partnerships and things like that.
Perfect. Excellent. And last but not least, Tony.
Right on.
You said the best for last because your name's so great.
Yeah, well, you got a great name. I love it. And you'd be surprised how many people spell mine with an I. It's like they don't realize the difference. But hey, I'm Tony Blodgett. I'm the Executive Vice President of Retail Sales at New American Funding, going on my 26th year in the mortgage industry, and I'm excited for this conversation. There's lots going on right now.
Excellent. Well, thank you guys so much. Appreciate your time, and thank you to the audience for being here. You know, we kind of had this started out. We sort of had a script of things to talk about, and in the last 4 days, that script has flipped. So we are going to get started. I'm going to just jump in and ask the question and let our panel of experts take it away. So what we want to know is, what are you seeing and hearing about today's mortgage market?
Yeah, it's definitely changed a lot, hasn't it? And I think what we all thought we would probably be talking about today has significantly changed over the last few days. And I don't think we can talk about the market without really talking about SVB and the changes that we've seen come about there.
Yeah, I totally agree, Amy Jo. I think that last Thursday, if you would have, gotten most people's opinion about what was going to happen, throughout the rest of the year, specifically with the Fed, I think most people would have projected, 75 basis point more increases by the Fed. And I think that if you were to ask today, you might get a different answer. Matter of fact, I'm seeing some projections as much as 0.75% lowering, by the Fed through the end of 2023. Now, I will say this, the last 24 hours was very telling. Here we are on Tuesday, and so much happened at the end of last week, and then just over the weekend, and in anticipation of these banks. Obviously started with Silicon Valley Bank and their situation and others. And what was the Fed going to do about it? And I got to be honest with you, it was kind of up in the air as we started the first of the week. I mean, mortgage bond prices got a lot better. We saw a huge rally early yesterday morning, and that slowly tapered off as the day went on. So, not nearly the gains that you might have expected. And I think part of this is because the Fed came in and did what they needed to do. They calmed people's nerves about the state of the banking industry, and they created a facility for these banks to be able to sell some of their assets at basically face value versus kind of current market value, which, as many of you I'm sure know, is what really put SVB into a state of essentially insolvency and a run on that bank because of their need to unload a number of their mortgage-backed securities and treasuries really at today's current value versus what the value was that they had on their books. Many of them were booked, as held toward, for maturity, which is, I think, what their plan was. But they found themselves in a spot of having to liquidate some of those assets. And it really uncovered what was really beneath the surface, right? And a lot of this goes all the way back to the changes with mark to market and some of the accounting practices that are in place. But look, what the Fed did, without getting too over, into the weeds here on this, is the Fed said, hey, we'll give you a facility. If for any reason you need to liquidate these assets, we'll purchase them at their full face value, and then we'll hold them through maturity. It's not going to be a burden on the taxpayers, and it's going to kind of put the confidence back into the banking system. And that was a good move. And I think that if you would have asked me first thing yesterday morning what I thought the Fed was going to do with interest rates moving forward, I would have said they're definitely going to pause, and they may even reverse course. I don't feel that way today, to be honest with you. I mean, we saw a CPI number come out. It was good, but not as great as we were expecting. I think the Fed's going to continue to stay course. I mean, inflation is still their primary focus. Look, they created this situation, and they're going to stay focused on inflation probably way too long. I personally think they could pivot at this point. I think we have a lot of lagging indicators that are going to show themselves here that, the Fed could probably ease up a little bit, but I don't think they're going to. I think yesterday, we had a lot that could have went wrong. They did some things right. It's going to calm people down, and we're back to focus on inflation is going to be driving mortgage rates, at least for the foreseeable future, in my opinion.
Yeah, calming people down and increasing the confidence in the market is so incredibly important. Emotion drives a lot of this stuff, specifically on the bank runs. You hear one company's pulling money out. Oh, I better pull mine out. And then it just goes and goes and goes. And so, yeah, you're right. I think the confidence in the marketplace is so important, and to keep that strong right now is huge. Fundamentals are a little bit different, but that sentiment is incredible. And it's such an important variable to consider in mortgage origination too, because borrowers are emotional, and spring is around the corner. It's not just because you're going around the town and looking at, the tulips in the front yard are blossoming here in about a month, maybe. And home pictures look more beautiful when sunshine is shining on grass. That is a huge variable in mortgage origination, and it can be, dependent on people's emotions too. So as people are taking note of what's going on in the economy, I think there's a lot of folks who are saying, is it time to jump off the fence? Is it time to reconsider my monthly financials now that rates have decreased? I'm just forecasting that maybe they will, and recalculate that business. Go make sure you have a loan officer out there that you're working with constantly, who's running through scenarios with you, because you never know what's going to happen. Yesterday, the market, rallied a ton, And then, like Tony, you said, it crawled back. What is that going to mean? What is the Fed going to do over the next 6 months? We have no idea, but it's really important for folks who are on the sidelines right now, who do want to buy, to keep a pulse and listen to the people that they trust most, because you never know. You might be ready to go to an open house and pull the trigger on making an offer here before you know it. You just have no idea.
Yeah, so much pent up energy, I think, in the housing market, which is what you're alluding to, Brian. And people are looking for those first signs of green grass and positivity with what the Fed does. And maybe if it is a rate increase, Tony, maybe it's a smaller one. Maybe it's just a little guy, and maybe it doesn't, freak everybody out. And it does continue that momentum, Brian, because I think there's so many people that are waiting to act, that have so much equity to maybe throw at this situation, buy down the rate, do different things with that equity. And I think folks are just waiting for a little bit of green grass for it.
Yeah, I think that a lot of folks, after kind of the comments that the Fed made last week, because remember, they were just commenting to Congress last week, and they were pretty hawkish, still about the resiliency of inflation. And I think the thought might have been that we'd see 50 basis points here. I think it's March 22nd is the Fed meeting, and now maybe it's a quarter, or maybe not. I don't know. I don't know that they really want to let up. They're not going to let this bank situation be too much of a distraction. Now, I will tell you from my perspective, the banks have challenges. I mean, they are paying out more money for deposits than ever. I mean, I know personally, I've moved some of my funds into, a preferred deposit account, or if you have CDs or whatnot, I mean, you can get up over 4%, yield on some of these very liquid types of deposits. And that means the bank has to find a way to still create arbitrage with the deposits they take in. And that's very difficult to do. Not to mention, they've bought a lot of assets like car loans and, shorter duration things, but still they have duration to them. And that was before rates started going up. And so there's challenges for banks. And I think you will continue to see, as a result of what's happened, this isn't behind us. It's not catastrophic, but there's still challenges for banks. And I think that you're going to see some tightening in some of the products that banks are offering in certain sectors of their business. So if you're an investor and you're used to getting, some takeout loans are going to be really important, and, strategizing how you get out of certain investments. I think maybe they aren't as much of a leader in some of the areas with the jumbo market and the ARM market, where we've seen them just completely be able to dominate many of those. I think that it backs up a little bit. I still think, again, this isn't a slam on banks. It's just the economics are significantly different than any of them have dealt with in a long time. And I'm no banking expert, but margin is margin, and yields are yields. And it doesn't take rocket science to figure out that it's going to be a challenging environment for them to navigate. And I think everyone will be happy when the Fed feels like they've finished their fight against inflation, and they can start to maybe unwind at least a little bit to deal with some of the unintended consequences that are obviously starting to show their head with this aggressive action by the Fed. I mean, we can handle higher interest rates. It's just when they move that fast over that short a period of time, it breaks other parts of the market, and we're starting to see signs of that.
Tony, you just said that you're not no banking expert, but you play a good one on TV right now. Would you want to be a bank CEO? I think right now is such an interesting time for those folks who are running these institutions, because you're right, like interest rates change so dramatically fast that the duration, the elasticity, the pricing of their bonds you don't know the ripple effects in that. You have to be a macroeconomics wizard to try and put that puzzle together, and still they get it wrong. Even the best of the best in the Fed get it wrong a lot of times. Well, so I'm not envious of those folks right now running these large, big ship organizations.
Yeah, I do want to say one other thing. Look, the reality is with Silicon Valley Bank and some of these others, this is a leadership issue. This is not an indictment of the whole banking industry. Yeah. Some people are navigating these challenges quite well. They did not have the right risk people in place to manage that. There's a lot that went on, I think,
great
with
marketing department or communications.
Yeah. Well, they might have been heavy in the marketing and not so much on the risk, right? But the reality is, I think it is important that we point out that this is not an indictment indictment of the whole banking industry. Yeah, there's challenges for the whole banking industry because of the reasons I just outlined, but they're not all failing, and they're not all going to have these same challenges because, they've done a better job of mitigating these risks and investing in different areas than what Silicon Valley Bank did. So I think that's important to point out for our banking friends out there. I think they're taking a lot of heat right now, and a lot of it's not warranted, quite frankly. But it is going to be a more challenging environment. And this isn't going to help them. This is the bad press.
Yeah, we work with both the lenders and the banks, as you know, Tony and Brian as well. But we saw basically a 20% uptick in January, and that's across the board. So I think there are both sides that are seeing positivity. I think that there are some that are dealing with more hamstrung effects from the market than others. So absolutely.
Well, another thing that I want to address about just the state of the mortgage, or just about the market itself. I mean, I feel like we are in this window of time. Look, yesterday was not that huge rally that I think is going to continue. It doesn't get the Fed to change pace, but look, inflation will come down. And I do think that, the second half of this year, we're going to see rates get better. And what's not going to get better is the inventory issues that we have. And so there really is this window of opportunity, which I'll be honest with you, even a few months ago, you could get a lot of seller concessions. I think that you saw the spread between listing price and actual sales price. They got as high as 4 to 6% in some markets. That's already narrowing. And the certain homes are already getting multiple offers, not because rates are so great, because they're not right now, but because of the lack of demand. And as rates do start improving, that demand is only going to grow, and it's going to become more and more difficult. So I do feel like there is this short window of opportunity for first-time home buyers to get into the market. I'm passionate about that right now. And it's one of those things where you go, should I be on the fence? No, you definitely shouldn't be, but you're not going to realize it in many cases until it's too late. And so, and that's just the reality, I think, of what happens. If rates get back into the low sixes, high fives, anywhere in the fives, it's like game on, and it's going to become very challenging. And the one thing that I am seeing as an opportunity, which could help us, is the higher end of the market is softening a little bit. And what we need more than anything right now is we need move up buyers to be willing to move up. And that's difficult, right? I mean, they got rates in the 3% range, and they're comfortable where they're at. So if they moved up, they'd have to go into a higher price and a higher rate. It's like a double whammy. And so we see a lot of people not moving like they normally would, creating that inventory for the first-time home buyer. But with the softening in the upper price range in many markets, with that softening and some improvement in rates, it might just be what's needed for people to move up into that price range and start freeing up some of that first-time home buyer inventory.
Yeah, and
that's
their
a bright
equity,
spot.
the equity they have. Yeah,
And the equity for sure.
absolutely.
Mark asked a question here on, isn't the inventory issue a bigger concern to the housing industry than mortgage rates? I would say yes, absolutely. I think, one thing that we get caught in the mortgage industry is looking too short term. And of course, we're talking right now, a lot of this is short term. Rates are short term. The inventory issue in housing is a massive long-term issue that does need to get solutioned. And maybe we need to schedule some other time to talk more deeply about that, because it's a big thing, and it has been for a long time, honestly. Todd, I want to address another question here in the chat. Thank you guys for also for submitting these. He asked, do you think illiquidity and mortgage-backed securities will continue to weigh on mortgages, how mortgages are priced on the retail side? I think, yes, absolutely. When you have the Fed stopping to buy, so the liquidity decreases, you have other buyers like Wells Fargo who aren't buying as much. That has a fundamental price or an impact on price and margin compression into mortgage-backed securities. Now, that also opens the door for a lot of other players to get in too. So I think we are at a really interesting fork as to who will be that liquidity provider. We still have the conservatorship, which is really hard to say, especially 5 times in a row. But I do think, similar to 2018, we saw mortgage compression or margin compression happen in the industry as a result of illiquidity. Something similar has played that role in the last couple of years, and it's uncertain, I guess, in the future how that will be, in my opinion. But it does open the door for new players, and if they see a recovery happening, if they see this industry as something special, which I think more and more are able to see because mortgage companies are going public. It's becoming more of a legible industry for bigger players to read into. Historically, you haven't been able to really understand and rip apart the financial statements of mortgage companies because they've been bundled up into a small rolled up section of a bank's 10K in their SEC filings. So now that you have other mortgage companies being public, it's much easier to read them and understand them fundamentally, where you could see some big asset players coming in and taking the role of Wells Fargo or other folks and creating more liquidity in the market. Tony, what are your thoughts on that with the illiquidity on the MBS from the Fed and maybe Wells Fargo too?
Well, we've been hearing about the private, sector stepping in for 10 years, but no, you touched on all the right points. I think another thing that I would add to the illiquidity and really how it is impacting the retail side of this business is the higher coupon prices, right? We have decent liquidity in the lower coupons. And even when you saw a rally yesterday, you typically tend to see the lower coupons do really well and the higher coupons not so well. And the reason for that is pretty obvious, because there's the duration's not going to be there, right? No one wants to invest in a higher coupon, or the market just moves so fast. I mean, February basically was a whole month of rates getting worse. And so it just, when it moves that fast, there just isn't liquidity established in those higher coupons, and no one really wants them because they're not going to be around for very long. And so that's really plaguing the retail side of our industry, especially if you're trying to make any amount of margin. And what it does is it creates situations where borrowers are having to pay discount points on almost every scenario if there's any amount of margin into these prices. And that is really exacerbating what you spoke of, which is the margin compression right now. I mean, it is really brutal to try to provide rates that to a consumer don't come with discount points. And if you are doing that, you're squeezing the margin on the retail side of the business. So that's another aspect of illiquidity, is just the higher note rates. And I can't wait for us to get down into a more lower and stable market where we can see, kind of that like a group of 2 or 3 coupons where most loans fall and slot into those coupons. We see a lot of liquidity and we can see some stability there, but that's just not what we've experienced for about the last year. Yeah.
I think the GSEs are really the ones who are winning the loans in the higher coupons right now, not any of the aggregators. But it is interesting to see how servicing is being represented in the marketplace in terms of price. And I'm not a servicing expert by any means. I get confused by it every single day. So who knows what's going to happen there? But that, of course, is also a huge variable when we're talking margin compression and maybe possible relief from that, and the uncertainty of where rates are going. That the servicing strip is the one that you'll see fluctuate most. And everybody has their own models of the value on that and what it means to their own unique portfolio and what it's hedging against and all this other stuff. And so I would keep a keen eye on servicing over the next really week, 2 weeks, to see what the variability is across your providers, and maybe go knocking on some co-issue doors or other aggregators to see what the price is, because you could find some margin out there that will give you relief from the compression.
Well, you're already seeing some of the public companies writing down their servicing values. We saw that with the fourth quarter numbers that came out. So,
Amy Jo, from talking to so many different lenders across the country, what is the sentiment right now as we're heading into this season, and specifically with some of the chaos that's happened and hopefully cooled over the last week?
Yeah, I think you're cooled. And I think that's where a lot of our customers and our conversations that our team is having with most of our customers is a calm sense of, we believe 2023 is going to be a better year. There's a lot of positive sentiment surrounding that, but there's a lot of insecurity around, we're going to wait and see too. Making big decisions. I think most of them are looking into ways that when things do creep back up, they're prepared. And I think that was something that we all hit on together as well, is being prepared for when things are back on track, making sure your efficiencies are there, making sure you can take advantage, Tony, of every single dollar, like you're talking, be it, margins are so compressed. It's the battle of, when it does get better, have we prepared ourselves better than we were maybe in 2020? And I think that's what you're seeing a lot of folks get ready for. I think there's a lot of calm positivity, we'll call it, surrounding the market and what's going to happen in 2023. A lot of our customers are very happy about where their numbers are headed so far this year. But again, I don't think anybody wants to jinx it either. I think everybody's got their eyes on it. Lots of people tuned in with us today, which is awesome. And I hope that, we continue to provide a resource for folks to be able to have that insight. We have an advantage in talking with a lot of our customers and seeing what they're saying and hearing and what their plans are for 2023. And it's that cool, calm, collected, we're building and we're ready for it when it does happen.
On the preparedness point that you made, I'm really curious, or actually really interested in how loan officers will approach that more directly with borrowers and prospects. It's like, hey, you have so many pieces of information to consume that are always constantly changing. How do you work with your borrowers or potential borrowers in the short term to maintain their confidence, specifically when the banking industry just had a blip, making sure that they're confident and that they understand what's going on, that when they are ready, they can pull the trigger, they can purchase that house. Tony, how do you work with the loan officers to help, I guess, maybe, work with their prospective borrowers as they're going through this time?
Well, I think it's education. I think it's being a student yourself of what's going on in the market. I mean, tuning into a conversation like this, tuning into other experts and being able to then take that information to your consumer and stay in touch with them through the process. You can't get a borrower, pre-approved or on the journey to home ownership and then abandon them and hope that they call you back when they're ready. Because there is a lot that goes on, both in their personal, family and their household. They're talking to friends, they're talking to family, they're watching the news, they're going to start writing their own script if you're not the one, writing it for them, if you will. So I think you have to be an expert yourself. You have to keep your finger on the pulse of what's going on in the markets more than ever. You have to understand this stuff and not just listen to other people talk about it, but take the time to learn it, and try to predict yourself what you think is going to happen. And then if you're right, go, why was I right? If I'm wrong, why was I wrong? What did I miss? What didn't I consider? What were the factors that happened that were, that we didn't see? And be willing to talk to your customers about those things, because that's what's going to give them the confidence to turn to you for advice. And that's what ultimately we want to do. We're here to give advice to people that are trying to get home loans. I mean, if it was as simple as just, sorry, but push a button and get a mortgage, it's not. We need advice. Right. And that's what it's our job to do, more so than
Tony, you're breaking up a little bit. I'm gonna jump in here. You're right. You said push button, get mortgage. Yeah, you're right. This is where loan officers really drive value
and strategic partnership.
Education. Absolutely. Yeah. They're so important because it's an incredibly complex transaction. Even if you've gone through it a few times before, it changes every single time. And you might forget when you last bought a house 10 years ago, maybe. And so there's a couple other questions I want to ask here to Amy Jo and to Tony. The question is, inflation. The last serious run was about 10 years long. What makes you think that it'll end sooner this time around? So inflation and potentially coming down. Tony, I think you alluded to that point here earlier. Why do you think inflation won't be this high for 10 years? Why do you think it'll come down?
Yeah. Can you guys hear me okay now?
Yep. Yeah, you're good.
Good. Well, I'll just give you one anecdotal reason. I recently had a off-road vehicle, Polaris Ranger, stolen from my property. So I went down to the bike shop to replace it. And there was more inventory in that bike shop than I had seen in over a decade. There was every color of every bike that you did, in dirt bike and quad and side by side and anything that you could ever dream of in that place. And I asked the guy, I said, this is crazy because a year ago you guys were empty. He said, I know. And he goes, we have more inventory than ever. And what I'm getting at here is this: you got to look at what caused the inflation in the first place. Obviously, a lot of it was the stimulus, but a lot of it was supply chain issues. A lot of this is repercussions of COVID and so on and so forth, right? And so, Barry Habib talks about this all the time. What causes inflation? It's too many dollars chasing too few goods. And that's what causes inflation. Well, look at what's happening now. We are going to have more and more goods on the shelves, right? We're going to have, the outdoor motorsports is just one area. It's happening, and it's going to happen in all other facets of goods and goods, and some services too, because services were really pent up as well. But then you think about, where's the dollars going to come to feed that? Well, look, people are making, people are, it's more expensive. They've been having to, rack up more of the debt, so on and so forth. So over this last time that we've been in this inflation cycle, people have been, having to put things on credit cards and things like that. And then the cost to service those credit card and service that debt has gone up. So those are dollars that are no longer available to spend on the street. Also, I talked about it. You can get 4%, 4.5% in a CD right now. If you have a lot of extra funds and you got nothing to put in the bank, you might go spend it. But if you can put it in the bank and get that level of return, that takes money off the streets, right? And so there's just so many factors right now that, based on the Fed's actions that are taking money off the street, based on the circumstances for people that have money to not spend it, people that didn't have any money have even less now, and they have to service that debt for a long time before it gets out. And the supply chain issues have freed up, and we have more inventory. So we have the exact opposite set of circumstances, where now we have a whole lot less money that's going to be chasing an oversupply of goods. That is why I think that we're going to see inflation curb. And the last piece of it is that I think that you're going to see shelter costs come down. Again, this has been talked about a lot. If you watch anyone who talks about the MBS market, it's a very lagging indicator. And as that starts, and it makes up 43% of CPI. So as that really starts showing itself, in many markets, home values have come down in some areas. Rents have come down in some areas. It takes a while for that to trickle into the numbers. And you add that with the supply chain issues no longer being broken and less dollars out there to go after these things. To me, it's pretty obvious what's going to happen. But again, the Fed is not going to let off. They're like a dog with a bone. They will continue to fight that until it is completely stamped out. And it's probably warranted, because inflation is the one thing that can really just ruin an economy. And they have to make sure that it's shut down, and they'll break some things. They already knew that. They said that from the get-go. We'll break some things in this process. That's okay, because we can stimulate quick. So they'll deal with that when the time comes. But that's why I think that it's not gonna stick around forever. I think we're gonna get through the inflation issues.
We're taking some medicine for sure. And the CPI came in overnight and met expectations. So it's a huge boost to the confidence in where we're going, and that trend that Tony referred to as well. Another question here about forecasting rates, and will they get to or stay below 6% without significantly higher unemployment? I think, we've talked a lot thus far about monetary policy and the work that the Fed is doing and creating an environment for good lending. Fiscal policy is also something that's incredibly important to these things too. And we've got a big election coming up right around the corner next year. And so you don't really know, of course, what's going to happen, but just knowing that any side of the table, they want to improve the economy, and there's going to be a lot of pressure to have rates lower to get into that season of caucusing and things like that. So I'm not, if anybody were really good at predicting interest rates, you'd probably be a billionaire. So it's usually a good bet to go against the grain on what people are forecasting with rates. But simply because of that and the need for fiscal policy, I do believe that rates will decrease over the next 18 months. Where, I have no idea, but
wait,
yeah.
I said I promised on LinkedIn I look into your crystal balls, and that's what we're taking a look into our crystal ball. I'm with you. I'm hopeful that it's within the next year, so I'll go a step further than that, Brian. But I think that we're going to see those employment indices catch up a little bit with what the Fed is doing, and that's eventually going to cool off their actions, hopefully sooner rather than later. But yeah, that would be my best guess as well.
Yeah,
because we are almost out of time, but I'd like to ask one more question for you guys to finish up. And if you do have a question, please drop it in the chat. If we don't have time to take that question, we will take it offline and send you the answer directly. But just tell us, what's your top piece of advice that you give lenders for 2023?
I can go first. I mean, be prepared. I think that if you make sure your house is in order, you're going to be ready for when things do bounce back. And you're probably already trying to provide that strategic partnership that you heard Tony talk so much about. And that's really been the focus, and the real buzzword of 2023 is being strategic, showing the value to your borrower that it, you know, when a loan falls in somebody's lap, like it did in 2020, everybody can figure it out, right? When it gets a little bit more difficult to figure out which programs, where you can make the most money, where you can hedge your bets, it's that strategic partnership that I think that comes through. And I would encourage us all to be strategic in that way and prep for 2023.
Yeah, I think mine is work hard. You got to work hard in this
That too,
market.
Tony.
work hard, work smart, be strategic, and make sure that you're being an advisor to your clients and also your referral partners. You need to bring value. You need to bring, you need to be knowledgeable, and you need to give great advice. You cannot be an order taker in a market like this. There's plenty of those out there. Someone will find a lower rate if you make it all about the rate. So give great advice, but you got to work hard. We were very blessed in this industry. I would say, obviously, for the last couple of years. I mean, the last year has been rough, but before that, the 2 years before that, man, this was easy. But really, the last decade's been pretty easy. Let's be honest. And you got to work hard right now. And for those that do, and you're focused on this as a long-term career, and you're going to educate yourself and be an expert and give advice, you're going to be just fine, because you know what's going to happen. Even though the mortgage market as a whole, maybe it's only 2 trillion, maybe it's 1.8 trillion. There's going to be a lot less people in this industry. I hate to say that, but it's true. But if you outwork the guy next to you, you'll be the one that's left over. And when business does tick up, it doesn't take as much of a tick up. We don't need to get back to $4 trillion for this to be a very lucrative industry, because it's never been that before. That was a unicorn, a $2.2 trillion market. That's phenomenal. And with a few less people going after that business, you guys, the opportunity is there. So work hard, persevere, get through this, and it's going to continue to be an awesome career for so many.
Well said. Yeah. Hard to follow that one up. I agree completely. I think, in addition, I would add leaning into what makes this industry the best, and that's relationships. Relationships with your referral partners, relationships with your capital markets partners at every little nook and cranny of your organization. Lean into your relationships on the external and, more importantly, internally. That's going to give each other great perspective. It's going to allow you to see the market a little bit more clearly. And if you can capitalize on what you're learning and building with these folks, you have a lot of runway ahead of you. So lean into it. Lean into your relationships.
We've got one more question that just came in that we can take. Are you seeing lenders adopt new ancillary products to engage and retain borrowers during the downturn? And what strategies are you seeing around this?
Yeah, absolutely. I think, it's the natural thing for mortgage companies to do is, if the volume decreases, go find some other avenues to get it. A lot of folks have leaned into, construction of perm, which they might not have done before, and making sure that the rates are appropriate and they can do things right, do it with it. Looking at non-QM, looking at all different types of loan products has been a standard practice for folks when volume goes down. You got to have a very, very, very careful eye on those things too, because you want to stay within your core competency. You don't want to lean into too much risk. So really understand it before you flip these things on. But that's one of them that I've seen, particularly if we're just talking IM, like mortgage, it's diversification and expansion of your product base.
Yeah, we had a couple customers that referred to it as dusting off the old product book, for sure.
Yeah, I think that it's, those things, reverse mortgages, one-time close, bringing on new products, relationships. Everyone that's long for the mortgage business is doing that. I haven't seen so much product expansion ever, quite honestly. But then I think there's other opportunities, other partnerships, in the areas of, insurance, for instance, home security, helping people with other aspects of the home buying and moving and owning a home experience. And those types of partnerships can bring additional revenue into an organization. It can provide and create an ecosystem for homeowners to rely on their lender, making them, a central part of the homeowner experience. And it also can bring in additional revenue, for not just revenue in dollars, but also leads and other resources by tapping into databases of these other ancillary services. So We're definitely exploring that. I know other companies are as well. And we're seeing a lot of that working. And I think it does make your client stickier with you when you can provide their mortgage, you can service their mortgage, and you can help them with other aspects of home ownership.
Yeah, Tony, one more piece on that is like, I've seen a lot of folks really dive into their own communities a bit more and differently than they have before, talking with attorneys, thinking about milestones of people. Hey, I'm getting married. I want a new house. Hey, I'm XYZ, thinking about all the different, positive and negative milestones in people's lives and how that might affect them, and looking at those ancillary networks that are represented by those milestones and getting relationships built with them. That's much more tactical than just having real estate agent referrals. You got to really embed yourself in the community. And that's what I've seen a lot of people do since, the lockdowns lifted and things like that.
Yeah, absolutely.
Well, thank you all again so much. As a reminder, TMC will send a follow-up email with the recording of this session to your inbox tomorrow. And Maxwell will also be sending their Q1 2023 lender report via email as well. So once again, thank you all so much for coming. Tony, Amy, Brian, fantastic conversation. Thank you all for bringing your expert topics to the TMC network. Thank you very much for stopping by with the TMC Connect. And until next time, have a great day.
Thanks,
Thank you, guys.
Thank you, everybody.
Appreciate
Thank
it. Bye-bye.